Without further ado, I'm very excited to have Julia LaRoche, who many of you know. She was our MC at our tremendous 2019 conference. She's now working at U.com. She's formerly of Yahoo.com, and we'd love to welcome Julia LaRoche as our MC for today. So hopefully she's somewhat nearby. Maybe she's not. But we'll get her down here. We'll start. So Julia, come if you hear me. Come when you can. Anyway, thank you all for being here today. Maybe we'll pause for a few minutes and then we'll have Julia starting the event. Here she is. Okay. She has to sort of make a special stage appearance. So.
Well, thank you. Thank you so much, Jim.
All right, take care, sir.
Good morning, and I'm so excited to welcome you all to Miami. It's great to have the Greenwich Economic Forum here. And what better way than to kick off today with a session on the future of cryptocurrency. So I'm going to introduce this session's panelists. We have Roger Bayston. He is the head of digital assets for Franklin Templeton, a global asset manager with more than 7 decades of experience. Lauren Abendschein is the head of America's institutional sales for Coinbase, the largest publicly traded crypto company. In their Q4 letter, Coinbase highlighted their relationship with Franklin as part of their institutional platform. In this session, Lauren will interview Roger on the evolution of Franklin's involvement in the cryptocurrency space and the future of cryptocurrency. I'll let you both take it away.
Thanks so much. Roger, thanks for joining me on stage today. What an exciting way to start the day with a digital asset prime broker interviewing a storied asset manager. Franklin Templeton, of course, needs no introduction to this audience. Roger, as the head of digital assets, I'd like you to take us through today how Franklin got involved in the space, the lessons that you've learned through your exploration, and your views on the evolution of the asset class. Let's start with your journey to becoming the head of digital assets at Franklin.
Well, Lauren, thanks for having us here today. Thank you, everybody, for joining us. My evolution really came with, I started at Franklin. I've been at Franklin a long time. Back before we were at Franklin Templeton, 1991, I started at Franklin Templeton. Cut my teeth in complex mortgage cash flow securities, by and large, and just was somebody who always had ideas and was constantly pursuing the idea of expanding opportunity sets. And with the objective of, if we could continue to expand the opportunity sets of available investments for our global clients, hopefully we'd have a better chance of raising risk-adjusted returns, not just encouraging clients to go out the risk spectrum, but actually increasing and shifting higher the risk-adjusted returns. And so as we started thinking about and observing the dramatic growth of digital assets, and I would say it was a little bit challenging at first because of the headlines around Bitcoin itself, and the Bitcoin being the flagship project inside of the distributed ledger technologies. The challenges that Bitcoin represented with thoughts of it being involved in various parts of the dark web or nefarious activity was always going to challenge the very head of businesses. But I think when we peeled back and looked at the technology itself and the idea that blockchains represent a new way of developing protocols and software and distributing those across industry, it became obvious that it was an important thing to be attentive to.
Yeah. And now Franklin's been exploring the digital assets space, for many years now, even back to 2017 when it was really only a blip for most institutions. Take us back to your initial exploration of the space. What did that look like?
Well, again, I think we were attentive to the projects that were going on, trying to find an application, but I think it hit a inflection point when we just decided to do some pure R&D activity. What could we do that was on top of the distributed ledger technologies that would be interesting? And so we moved into it with an idea that we'd put a fund vehicle, attempt to put a fund vehicle on chain, and what we thought would be the largest, most complex project to do would be able to do that with a money fund. And I think we chose a money fund because we knew that money funds for lots of decades have been used in payments and transactional purposes. There's been debit card and check writing capabilities on top of money funds. And so we knew the velocity might be higher than a longer term investment where there were subscriptions and redemptions. And so we thought, well, this will be a place where we could at least start. And it has come with a great deal of learnings as a result of going down that path.
And tell us more about the structure of the money market fund. What is this? How does this work?
Well, it's just a traditional money fund, like all money funds, but in this case, the transaction records are actually maintained on a public blockchain. The public blockchain that we chose for this particular project was Stellar for a number of different reasons. But all of the proprietary information and personal information that might exist, the customer's information is actually still held in proprietary data in Franklin Templeton's records. But the transaction records are held on a public blockchain, which results in actually what we expect to be potentially cost savings for clients and shareholders in the long term, and added utility and functionality.
Right. And you crossed a major landmark by gaining SEC approval for the money market fund. Talk to us about what that process was like and sort of the regulatory engagement that required that launch.
Yeah, that was a real interesting process over really spanning several years of actually going into the SEC and saying, this is what we're thinking about doing. Should we do this? Will we be met with resistance? Because at the end of the day, the SEC doesn't send you this plaque or this golden certificate that says, you're free to do this. What they really do is just allow you to move forward. But it involved several years of discussions with lots of different parts of the staff. We are actually governed in the mutual fund space under the investment management staff, but we found that almost all of our meetings were attended by a cross-reference of people at the staff who were trying to learn as much as they possibly could about the space and what we were doing. And it really was an interesting collaborative moment because, I've worked in asset management now since really 1986, and I can tell you that our general counsel, if they had gotten a phone call from the SEC, usually it meant shaking hands or quaking feet in some way, like there was some problem. But so it was really great to be in a collaboration with them and the cadence of that, and certainly appreciate the staff's attention to what we were trying to do, and they saw the benefits and the opportunities that might exist for savers, because the staff is really intent on protecting savers in the long term, but going down this path of, is there new technologies that will benefit and provide more utilities to savers, really enlightened by them to be able to take this step to allow us to have the official transaction records held in a public blockchain for the first time.
That's a really exciting development. And so you had this sort of full sweep of learnings here. Talk to us about what other projects Franklin has incubated during your digital asset journey.
Well, I think what really began to happen as we started going down this particular project, our project Benji is what we're calling it. What we learned was, again, the operational importance, the benefits of being able to operate rather than inside of a single monolithic centralized database inside of our transfer agency system at Franklin Templeton. To be able to hold that on a public blockchain, we went through a whole bunch of different type of learnings. Number one, we knew that we had to own, we as Franklin Resources, the parent company to Franklin Templeton, needed to own stellar lumens on our balance sheet in order to do each individual transaction record on behalf of the shareholders. And, that becomes an epiphany moment because you're beginning to think, we're talking about records, distributed ledger. When you think about all the different type of ledgers or records that are used across any number of industries, you begin to be enlightened by the fact that there's going to be a whole bunch of organizations, business, commercial enterprises who are going to need to hold cryptocurrencies as part of their balance sheets in order to operate on side of these ledgers. And so you begin to think about, this is just the beginning of what could be a fairly large thematic expansion of adoption of cryptocurrencies, not by individual traders who are, trying to take advantage of these new themes, but actually an integration into the kind of industrial complex, dare I say, about these type of technologies and what it might mean. And so that opens up your eyes. We say, okay, there's all these different applications going on. Okay, there's lots of different layer 1, layer 2 projects going on. As an asset manager, is there a place here for us to render advice services on behalf of our clients to navigate these waters? Because, there's a lot of, like anything, there's a lot of great ideas. There's a lot of ideas that just have a lot of fluff around them. And so kind of to separate those out to be able to offer that advice, whether it's, established, more mature, listed cryptocurrencies that you might find, on Coinbase, for example, or brand new projects that are just beginning to incubate and trying to solve other problems. Offering an array of services up and down that whole spectrum seemed like was going to be a really good idea.
Yeah, so it really feels like a sort of learn by doing moment. And so let's turn to some of the lessons learned specifically around investing. So what were some of the insights that you gained from exploring the space in terms of how you thought about companies in the space and investing?
Well, we realized we need different skill sets to assess these. Each individual layer 1 blockchain has its own unique attributes that have to be teased out. There's different tokenomics, so to speak, inside of each one, and so be able to understand those. We began to actually apply a small army of data scientists that we have used for other investment strategies and services to begin to look at the data that was available on the public blockchains that would give us an idea, another frame of reference of understanding. Of course, all of this had to happen and could only happen because at the senior level of Franklin Templeton, Jennifer Johnson, our CEO, really, she had a lot of experience on the operations side. And so all of these learnings that we began to apply was super apparent for her, given her background. And so to be able to, all of these things, data scientists, they cost money. It's an investment. As opposed to just repurposing existing talent, you need to invest in new type of talent and new type of people paying attention here. And so that comes with a price. But at the end of the day, I think we're in the risk-taking business as opposed to risk management business. And so that's just part of the risk. And I think, in asset management, we need to have the same R&D activities as any other sort of industrial enterprise. In fact, I think, when I think about my 30-some years in asset management now, the plethora of opportunities that are in front as a result of these technologies, I think, makes it pretty exciting.
And what do you think are some of those opportunities? I mean, as we sort of look, 5, 10 years in the future, how do we think about the impact of blockchain and cryptocurrencies, on the development of investing opportunities?
Well, I think it comes in a number of different ways. One is, I think, by operating on in a blockchain environment, we're going to be kind of, in many ways, rebuilding some of the infrastructure of what we call TradFi, traditional finance. As more of this technology is interlaid, it's just going to be a big lift to move traditional financial markets onto that space. And that's just going to represent opportunity. I think it means that things are going to happen. Settlement times are going to decrease. And that's going to be an important shift. And it could, and there's probably application across any number of places with regard to that. But, it's this idea that, we're seeing things like NFTs develop. And lots of people when they think of NFTs, first of all, inside of an institution like this, as Art Museum, we think about how there might be digital representation of more creative expressions like art. But we actually have a different thought. We think about, or maybe a complementary thought, and that is we think of NFTs as potentially an individual loan that somebody might have. If you, Lauren, have a mortgage on your specific home in Northern California, that's a very unique asset that's applied only to the title of your specific property. And as a result, that meets the definition of an NFT should that loan actually be held on chain. And so then you have to start thinking about what is the various pieces of infrastructure you need to have as the regulatory environment unfolds to be able to deal with some of these things. Because should your loan need to be sold in a fractional place to multiple investors, we know for sure that the regulators think of that as a securities-related transaction. And so you think, to the extent NFTs are traded individually, that's one thing, but to the extent the definition broadens out and includes other assets like a loan, a corporate loan, or an individual loan, and that gets to be spliced in some way, shape, or form, now you're dealing with a securities-related business. And so you have to start thinking about how you cobble together the various parts of the infrastructure that you need in order to operate. Now, Franklin Templeton is a large organization, right? We manage trillions of dollars all over the globe. And so we think about those things as investments, about what we need to do to be able to prepare for the future.
I think it's really intriguing, and certainly that's not the connotation that NFTs have to most folks. So I think it's a really interesting advancement in how you're thinking about the space. When we think about some of these other areas, the metaverse, digital real estate, tokens themselves, what are some of the other investing applications that you see there?
Well, the metaverse, that's an interesting topic. Talk about transitioning from TradFi to something else.
Yeah.
What we think about when we're thinking about the metaverse, and we try to carve time into our week, into our work week, in order to do some exploration of this stuff. Rather than just focus on our jobs at hand, we do have to try to peel back and try to do some creative thinking about an exploration about what might be coming. And with regard to the metaverse, we just understand that as people's eyeballs and their attention span shifts and goes and focuses on certain things, we know there's a lot of value that's created there. It's like, my grandfather used to sit in his chair and read the newspaper, 60 years ago. Specifically, I developed newspaper reading habits from watching my grandfather. And so that's where that media had a lot of value. As that shifted, to television and now to mobile devices and now potentially to other things like the metaverse, as people's time and attention go there, then there's going to be massive value going on there. So that's the first thing, to pay attention to that. But the second thing that we are learning is, like, for example, in gaming has made a big shift from pay to play. So in other words, I need to buy a video game from somebody in order to play the game. It is making a monumental shift to being paid to play. And as a result about that, you are creating sizable assets. And we know from TradFi that anytime that you can create a value in an asset, that there's going to be capital market activity that's going to happen. You can borrow against it, you can lend against it, you can do other things as a result of this asset having value. And so that's where we're paying attention, not only about how can you earn money and be paid to play in some of these environments, but in addition about you're creating large amounts of assets off of which there'll be other ways that money can be made. And so, all of that is still a little bit on the come, but it does, as I mentioned before, really dramatically broaden and expand the definition of assets that might be blended into client portfolios in order to create a better experience. I live in California, as you do, and one of the challenges that CalPERS, the pension plan, has had in California is the idea that they need to continue to eke out the risk spectrum in order to earn those accrual rates that they have, assuming rates of return in the liability. So they keep pushing themselves out the risk spectrum. What if by through these technologies that are coming to bear, that we can actually shift up the efficient frontier rather than just simply encourage investors to go out the risk spectrum? That's where that is kind of the thoughts that we have when we're exploring what the future state might be.
Yeah, and as you think about that, we sort of take large institutional investors, where do digital assets potentially belong in their portfolio, and how might that change, in the coming years?
Well, the way I like to think about it is, we use the words cryptocurrency, digital assets, blockchain technologies kind of interchangeably. And what we're super attentive to is the fact that we see that the blockchain technologies are these massive protocol, both development and expansion platforms. If we think about protocols, I'll remind you that in 1989, HTTP, which is Hypertext Transfer Protocol, came into being. 1998, Google was started based primarily on that protocol. And you think about, wow, you'd like to have owned Google in 1998, right? And so what we see is that these blockchain networks are building new generations of protocols, standards that are going to be applied across various industries. And so, like, don't we really want to be attentive to that in a number of different ways? Number one, because we might be able to find, the next Google, so to speak, and we want to have that in our client portfolios. But secondly, it's like, what does all of that mean? All of that change and disruption mean to the assets that you currently own, the companies that which you might own equity, or you might have, you might be in a lending position with them, having lent them money. If there is a disruptive nature to that, another iteration and a further expansion of technology innovation, you want to be on the front side of that because it helps protect not only your current book of business, but it gives you new opportunities going forward.
Well, and yeah, let's dig into that a little bit more, because we talked about the sort of disruptive nature of play to earn, this sort of disruptive nature of NFTs. What are some of the other ways in which blockchain and crypto assets become disruptive technology that really influence and impact institutional investor portfolios?
Well, I think in the same vein that I've been speaking about, it offers these new opportunities, and it certainly is going to be helpful when we have more regulatory visibility about how these are going to be considered from various regulatory authorities. And I know that's maybe one of the topics here that we're talking about today. I think that's going to be a really important step for more adoption, for more exploration, for more capital coming into the space in order to tee up and potentially find success in more projects. But this idea that it enables newer opportunities is just really important to be attentive to. Now, there's a lot of building blocks, I think, that have to come alongside in order for that adoption to happen that are different from what we see in some of the TradFi markets. But the idea that I just think Franklin Templeton wants to be on the front side of what those opportunities may be before regulatory clarity comes to pass, in order to be prepared for that and give our chance for our clients and our global clients to have success rather than be reactionary.
So thinking about some of the key pieces that need to sort of come together in order to enable the development of this space, maybe let's start from a historical perspective. What are the parallels that you see in the development of digital assets to other asset classes and the formation of other asset classes? Are there sort of parallels that we can draw on that might inform how we think about the future of this space?
Well, it's really interesting because I know that there's going to be a discussion a little bit later about correlation in the markets and providing some insight about correlation in the markets. One of the challenges that investors may have, some traditional investors may have, especially asset allocators in the current space, is the idea that you're going to weave in these assets, correlation matrices, covariance matrices across asset classes. You'd be looking at this, you'd be saying, how exactly am I going to improve my risk-adjusted returns when I'm weaving in an asset that has 100% volatility, right? Which is the kind of the volatility we've seen over the last period of time. Well, again, it's a sign that I think that's a parallel in other markets where until you have wider institutional activity, whether it's from market-making behavior that potentially shrinks down the volatility in some spaces, all of these are the less mature parts of the market. You have to have a visibility about the thematic things that we're talking about here. These protocol expansions, this idea that adoption could probably happen much quicker because there's a community of people benefiting from it. if we were talking about a piece of software that was developed by somebody like Oracle that had to be sold by a whole bunch of sales people across the planet, that adoption rate is likely going to be slower than when you have a community of people who are benefiting because they all are participating in the rising value of the network as reflected in the cryptocurrency. We would expect that adoption rate to be happen faster. So, we're taking less mature markets and they're going to shift toward more maturity. I think one of the real key things that's going to have to come online is a continued expansion of the derivative markets, because the derivative markets allow investors to risk manage their portfolios. You're just not exposed to the volatility of the spot. You actually have more tools that will allow you to be able to manage toward those risks in different ways. So I think that's something that we're attentive to, the continued expansion of the derivative markets beyond just Bitcoin and Ethereum. And we do hold investments at Franklin Templeton in potential derivative expansion because we see that as extremely important. Risk management systems themselves have to be tweaked to include cryptocurrencies as part of the entire risk process. And an interesting thing too that we have found that I won't switch the tables and ask you about, but it's this dynamic that exists inside of the cryptocurrency markets where custody is also linked with the exchanges. Because historically in the TradFi markets, you have seen, your service stack is different. You can choose your custodian, whoever the custodian is going to be, and you can choose all the service providers in that stack. And currently, that's not as possible currently at this stage of the cryptocurrency markets. And I'm reminded that really the United States post World War II has a fairly unique situation in that most investors rely only on one custodian. I think in Europe, for example, as a result of World War II and what happened in Germany, there has historically been a more of a framework of having multiple custodians serve your assets because of the risk of any one case of assets just being taken away. Obviously, the geopolitical events around the world now probably heighten that once again. But it's these changes that, or these eventualities that I think institutional investors have to come to more of understanding. When you are owning assets and you are custodying assets, what exactly are you custodying? You're really custodying private keys to be able to transact those assets. It's a different dynamic. So I think we will continue to move forward because of the benefits that these are providing, as I mentioned at the very beginning, in industrialization applications across any number of industries, not just financial markets, that the blockchain technologies will come to bear. And I think that will keep accelerating those infrastructures that will allow even more adoption.
Makes a lot of sense. We'll actually be talking later on today about crypto prime brokerage, so we can sort of parse through some of the key market developments that you talked about. But certainly that market structure is really important for investors to think about. Let's talk briefly. I think this is important to touch on the relationship between blockchain and digital assets and ESG, given how topical that really is for institutional investors.
Well, I think some of the big headlines relative to blockchain has specifically to do with the high energy usage of Bitcoin itself. And I think what we're understanding is Bitcoin being the very first and, obviously highest profile blockchain technology. Just like any technologies, we see innovation continuing to happen. The proof of stake networks as opposed to proof of work networks. And we're seeing Ethereum going to be tilting toward proof of stake. A lot less energy usage in the proof of stake networks as opposed to the proof of work networks. But that's just only one component. That would be the E component of the ESG. I think what we are concluding is, first of all, there's amount of democratization that occurs operating inside of a blockchain network. And so you begin to think about the other factors, the S and the G, and you begin to think about applying those versus other organizations or companies, public companies, or even private companies. And I think we're finding that on both on the S and the G components, the governance especially. I mean, there are rules about how these blockchains work. That's exactly how they work. They're very hard and fast rules, and those rules are made by the community members. They're not made by a board of directors of potential insiders on a public company. So there's these components that I think that we are encouraged about that have to do with increasing innovation as it relates to the energy intensity of blockchain networks in the new projects moving forward away from Bitcoin that I think helps meet ESG standards. The societal and the corporate governance aspects, I think actually may rate higher than what you see in other type of companies. So I think what we're going to end up finding is that blockchain networks actually do pretty well as ESG lenses and frames begin to be applied specifically on blockchain networks, which I think that's it. We haven't gone down a long path on that yet, but as we're beginning to think about ESG as it applies to these new opportunities, I think we're going to be looking past Bitcoin itself, and we're going to find the benefits that they provide is actually going to allow them a placeholder in institutional portfolios rather than just being excluded.
Well, I think that's really encouraging, and sort of expanding beyond just the E, which gets the most sort of attention here, is really, really important. Well, in our final moments, would love to sort of wrap on any last key milestones that you think will really catalyze institutional adoption in this space.
Well, our epiphany moment, as I mentioned before, was just this idea that when you realize that so many different industrial usages of distributed ledger, the benefits of the records systems come to apply, I think more people will begin to understand how corporate America will begin to own these in sizable parts in order to operate their businesses. And that becomes just another tipping point in a wave. Now, again, should the regulatory authorities come to say that any of this activity is a securities-related business, then that cracks open, every one of our portfolios to adoption, and there's going to be just a rush, additional rush of activity beyond what we've already seen into this space. So I think those are big tipping points.
Well, Roger, thank you so much for your insights today. This has been great.